Okay, we're talking about quick valuation today, the first component in our quick valuation suite. This is our #1 product, our flagship product. This is the product that got the company going way back in 2001. I started development on this, and it's evolved over the years, of course, and it's still the best product of all of them. I like the other ones too, and they're kind of nice add-ons, and they're great in their own right. But if the world were to crash, or my world were to crash, and all this software disappeared, and I could only keep one, it would be this one. This would be the product I'd really want, because I get all the income statements and balance sheets and all the history of the company for the last 20 years, and I, do my forecasts, I do my valuation. Like this is really all the theory is behind this one. So also I want to mention that the theory and like the methodology and the theory would go with this, like, so they match. Like, we took that theory and then put it into a software piece. So we're going to try and give you the basics in this one, and then we'll go to level 2 in the next one, which is kind of some more details and maybe a bit more how the theory ties in. We'll see how that kind of pans out. But okay, so let's jump in. We need this scene right here. Okay. So this these white bars, that's where we want to start, is really right in these graphics, with the white bars being the historical rate of return on capital, or cash flow IRR. I often will say return on capital, but I really mean our proprietary cash flow IRR. It's a more sophisticated way of doing a return on invested capital, and that's in the theoretical methodology component. And then the bottom here is the invested capital growth. So in this particular year, let's say it grew 17%. Next year it grew 5%. And then this orange bar is the rate at which it could grow if it earned its, if it put, it's a plowback. It's a plowback. If you took the cash they earned from the year before and put that back into the business, that's the rate they could grow at. So this company grows below that, and you do that by repurchasing shares, paying down debt, or paying a dividend. Okay, so I can see just by looking at this data that they're repurchasing shares a little bit. I can't tell from this chart actually if they're paying down debt, but we can somewhere else in the software. And they do pay a little bit of a dividend. So that's how you can actually grow your capital below the plowback rate, because the way accounting works is you get your retained earnings, and that's just automatically added to your balance sheet, and would be new capital. Okay, but if it doesn't grow that as fast as that, well, something must have happened, and it's one of those three things. Okay, so all right, yeah, we talked about the white, it being the historical. Also, we've overlaid the stock chart, so this kind of beige yellow is the stock chart, and we try and match it up historically with the return. So in other words, the same time frame. So this is January 2014. So they earned 22%, and that's where the stock was. And I'm going to show you lots of correlation between the return on invested capital and the stock price. Okay, we'll do a couple of examples. Okay, then we get into the light blue. And oh, I didn't mention this white over here is the actual numbers that are creating these charts here. And then we do have yellow, which is earnings estimates. We don't put that in the chart, but it's just there just for observation. We get earnings estimate, we kind of go, oh, okay, well, based on that, it's a high level thing, like, well, based on earnings we think the return on capital will be this, but it's a difficult thing to do, and I'm not going to get into why, but earnings are not cash flow. We use cash flow, that's suffice to say, plus we have no idea what the balance sheet is going to be, but we take an estimate. Okay, the blue is, we're back to reality again, or actuals, and it's the trailing 4 quarters. So this is actually a good example. We have the January 2018 year end, so they have an unusual year end, this company, and we have the October 18 quarter. So we're 3 quarters in for this company. I guess we're awaiting the January 2019, which will be their year end. And at that point, the annuals will match the trailing 4 quarters. Okay. And then we have to do a forecast, and that's this dark blue, and then this long-term thing here. This is actually separated into two separate forecast periods. The first being the first 5 years, so we just kind of have this forecast here. And then we say in the long run, companies return to the long run cost of capital, kind of in the, or the, yeah, cost of capital, or the rate that companies generally earn in the long run. And this is from year 6 to year 40. So in total, it's a 40-year forecast. All right. And we're doing the same thing with capital. Okay. So this particular company, we have a small fade in the first 5 years because, you know, it hasn't really faded much. That's what the algorithm just kind of spits out. And same with capital growth. There's a whole whole algorithm on how to come up with this, but it's influenced by the plowback and the trend and a whole bunch of stuff, but we don't need to get into that in this one. And anyways, it generates a valuation, and it comes up with $65 and it's trading at 50. Off the top, it looks like a buy. Now we're going to do, you know, scenarios and things like that to see if that's true, or if it's rigorous. So for instance, you might say, well, you know, this looks a bit high. You know, it's sure, the algorithm says 24, but what happens if they go back to say 16? Okay, so let's do that in year 5. We'll put that in year 5, and all of a sudden it's only worth 45. So that could happen. That's a reasonable scenario, and if you had a good hypothesis for why returns would go back to 16%, I'd have a listen, and maybe we would put that in our forecast. And we do this all the time. And we do scenarios, we maybe do a worst case and we could save it, and then we could do another case and we call that our base case, and then we could do a best case. You know, we actually publish those. We do this with analysts and myself. I publish these actual targets, or cases, I guess we call them. And yeah, so that's a very important thing to do. Okay, let me just remind myself of stay on topic here. Okay, interpreting cash flow and capital growth, absolutely got to do that. Understanding the valuation breakdown, yes, this is important. Again, this ties back to our theoretical component, our methodology. Maybe I can zoom in. I think that would be really good. Yeah, I can do this. I'm very capable of doing this. I'm trying to get to this valuation section. Where it says, it's red right now, and it says quick valuation. Okay, so we really break down our valuation into 3 components. We say it's fixed capital, which in this case is worth $6.2 billion, or $5 a share. Then it's worth its working capital, which is just cash basically, another $2.68, or $3.3 billion. And then it's the speculative piece, because it's the future forecast. We say that's worth $55 billion, so quite a bit. And then we add it all up, and we say, oh, okay, so $5, $2, and $45, and that's a total of 53. And when we take out the debt, and we say, well, whatever's left over is the value of the equity, so $50. And that's what it's trading at. And you'll notice every number is the same on our intrinsic value model, except for the present value of incremental cash flow. So the future part is different, whereas, you know, the value of fixed capital and working capital, well, whether it's the market doing it or us, I mean, those are near cash items, so everyone should have the same value for them. As long as the accounting is done properly, there's no reason to doubt it. And same with the debt. So the really only difficult one is trying to get the present value of incremental cash flow. When I say incremental, that's over and above the cost of capital. So as you see in our one forecast here, we brought down the return to 16%. We just go back to the default, we get a $65. Now that's because $65 value, and that's because we're saying it's earned 24% return on invested capital, which generates a higher cash flow and therefore a higher value. So again, so this is a new point. Yeah, so 24% return on capital with this amount of capital, this 28 billion, generates EBITDA of 9.5 billion, or cash flow from operations of 6.6 billion, and this is really the number we're discounting back to the present value minus the cost of capital. We put the cost of capital in here, and that generates, you don't see it in this part of the model, but somewhere we're calculating the cost of capital, and it's only the spread that we're discounting, because we're saying it's worth its fixed capital, working capital, plus future cash flows above or below the cost of capital, because you can destroy value as well if you earn below the cost of capital. Okay, so there's some really good points. I want to stay on point here. Understanding valuation breakdown, did that. Understanding scenarios and valuation. Oh yeah, one last thing here is a back test. So we can we have this button here, and it's going to go through, and we're going to do this in real time, and it's going to calculate every quarter for that we have data for, which is 24 years worth, or 20 years, excuse me, of data, and we get our valuation, which is this yellow with the orange with the yellow dots, and every one of those is the valuation at the time, and this was the actual stock chart. So I think this is a good one. You know, we were saying for many periods here that it was undervalued, and it was going up in our valuation every quarter as well, and the stock was doing the same, but it was we were always saying it was undervalued. So we have liked, this is TJX or TJ Maxx, TJX companies, and we've liked this for a long time. It's been in our recommendations forever, and you can see why. It's a great company, and you know, the back test looks good, and it still looks good, so there's a good example.